Hello again from all of us here at Robare and Jones. I hope you all are well as we prepare for the next few days until Christmas as of the recording of this video. On top of that, we've got the end of the year upon us and the new year to look forward to. And we're just going to take a little bit of time to go through some of the changes that we're going to be making to the portfolios. First and foremost, on the equity side of the portfolio, we're really going to be reducing risk across the board. The biggest thing, we're taking advantage of all the equity power. I guess the history that we've had over the last couple of years, we have been overweight equity by about 3 to 4%, depending on portfolio. So we're going to be scaling that back. Those have done well, even though in the recent months, the equities have been a little shakier. But because of our overweight to energy value and our commodity position that we had entering into 2022, we've actually held value a lot better than the overall index, which would be the S&P 500. On top of that, we're going to be reducing our international exposure, namely getting out of emerging markets altogether. Recall I think it was in the beginning of the year, we entered into a emerging market position, but we omitted any Chinese exposure. And that kind of goes without saying as to why with all that's going on. And I think that it's going to be an interesting next 5 years, 2027 being kind of, there could be a Taiwan invasion. That's at least what the Chinese government, of course, says that they're not going to do. But somehow 2027 keeps popping up as that goal. So we're going to continue to be light on the emerging markets. And it's just we're expecting volatility going into 2023. And because of that, we're just shoring up some of our equity portfolio, really focusing on lower volatility so that we're well poised to take advantage of any opportunities that further volatility will create. That kind of goes back into the cash discussion that we've had throughout the year. We are retaining our cash overweight, but focus is going to be, especially on the equity side, very, very domestic focused, big blue chip dividend paying companies. Cash flow dividends tend to be king in these kind of times where growth is less certain. Cash flow makes more sense. So those themes are going to carry on. Most of those themes have been present since the beginning of the year, but we are just shoring up. None of us expected perhaps the volatility that we saw this year. The Fed, in hindsight, was a little bit late in their decision to raise interest rates to combat rising inflation. All the things that have happened throughout it's been a long year with a lot of things that have occurred that have affected, pretty much everybody. So moving on to the fixed income side of the portfolio, that's where the biggest change is going to be. We're going to be, again, shoring up interest rate risk. So one of the things that we're going to be selling is our longer dated treasury, inflation protected treasuries. So the position is called TIPS. So that one's going to be going away, and in its place, we're going to be adding some mortgage-backed securities, and this is really to complement some of the treasury, kind of your boring, we want investment grade in the case of an equity market shock, which could happen. Typically, we will see those act as a ballast, but with interest rates rising and the risk of mortgage prepayment is now almost null, we think that this is going to be a very good place to be, at least for the time being, even long term. And so with that being said, the final new position that we're going to be adding, part of this sale is going to be from selling the emerging market position, as well as a portion of the TIPS position is going to be a defined risk position. So it's at its core, it's going to be a corporate bond investment, corporate bond portfolio, but there's an option overlay that lets it kind of act and participate in the equity market, even though the core portfolio is corporate bonds. The position will allow us to remain invested in a bond portfolio, an investment grade bond portfolio, but at the same time have an option overlay that helps reduce our exposure to interest rate risk as the market has responded today to kind of the more hawkish stance that the Fed has taken, especially with these job numbers that keep on coming up. This is one of those rare markets where good job markets, it's not necessarily good news to the markets because that's a driver of inflation. And so part of what the Fed is trying to do, obviously, they want inflation to come down. And the best way for them to do that, their most powerful tool, is to raise short-term interest rates. And that's what we've seen over the last 12 months. And that is negative on bonds. And it's also been negative on the equities because we entered into this year with a very highly valued equity market with the tech companies kind of leading the way. And they are also the biggest losers. Thankfully, we were underweight tech coming into 2022, and we remain that way. We did enter into a growth position last rebalance, but we did it very strategically in that we wanted to omit some of the larger positions within the top 10 of the S&P 500. And so far, it's been negative, but it's not as negative as the overall growth position, the NASDAQ, for example. So continuing on those themes, the addition of that defined risk position, it also is going to be able to participate in the upside on the equity, some of the downside as well because of the option overlay. But again, because of the way that portfolio is constructed, there's going to be a definition of what the lowest it will go. So in short, to summarize, we're really just making small tweaks to shore up against any possible unseen or unexpected volatility going into 2023, especially the first quarter. And we're going to have that cash remain as kind of dry powder because as volatility increases, that's when we are able to see those opportunities present themselves in a much clearer and succinct manner. So as always, thank you so much for your trust and confidence. We wish you and your family a very Merry Christmas, Happy Holidays, as well as a very, very Happy New Year. If you have any questions at all, please don't hesitate to reach out and ask any one of us. Doesn't have to be about the rebalance, or it could be as detailed as tell me more about that defined risk position. We'd love to hear from you. So with that, again, Merry Christmas. Y'all have a great one, and we'll look forward to seeing you all in 2023.